Welcome back to Mortgagenomics Canada. I'm your host, Marco Gello. I'm a duly licensed mortgage broker in British Columbia and Alberta, born and raised in Calgary, currently living in North Vancouver. If you are from either of these provinces and require any mortgage-related services, please do not hesitate to contact me. Call or text me right now at 604-800-9593, 604-800-9593. One application, one credit check, and access to Canada's top lenders. Today I'm going to talk about converting your variable or adjustable rate mortgage into a fixed term. Let's begin. When shopping for a mortgage in Canada, one of the big decisions you'll face is whether to go fixed or variable. For those leaning variable, it's important to understand how prime rate linked mortgages actually work and the subtle but critical differences between the two main types that are available. So before we get into the conversion feature of variable rate mortgages, let's first get a handle on the fact that there are two types of prime rate linked mortgages. The first one is known as adjustable rate mortgage, also known as ARM. With an adjustable rate mortgage, your payment moves up or down whenever the lender's prime rate changes. So for example, if prime rises by 0.25%, your interest rate rises accordingly, and so does your payment. The benefit of an adjustable mortgage is that your amortization, which is the length of time it will take to pay off your mortgage, stays on track, since the payment is always recalculated. It's always changing to reflect the prevailing interest rate. Conversely, if prime rate falls, your payment decreases to maintain the original amortization again. Some people would prefer that the payment should stay the same in a falling rate environment, especially if you are already comfortable and used to making the payment, so that more money can be applied towards the principal. But the nature of the product doesn't allow for this automatically. That said, you can manually request to keep your payment at its previous level to accelerate your prepayment this way. It just isn't built into the product by default. The other prime rate linked mortgage is more popularly referred to as a variable rate mortgage, also known as a VRM. Here, your payment stays the same regardless of prime rate changes. Okay, so if prime rate goes up, your payment stays the same. But what does change is how much of your payment goes towards interest versus principal. So in a falling rate environment, more money gets applied to the principal. So this is great, and it's automatic. More if your payment is now being allocated to the principal and you're on a faster track to pay down the mortgage. However, in a rising rate environment, more of your payment is allocated towards the interest. Therefore, your principal contribution is less and your amortization starts to expand. This distinction alone between adjustable and variable is the single most important thing to grasp before committing to a variable type of mortgage. People jump into these products and expect that there is no maintenance involved whatsoever. But as we have heard during the recovery from the COVID era, you hear about these crazy massive amortizations that some variable rate mortgage holders were left with during the rise of rates, when we went from the nearly 1% to almost 7%. And people didn't maintain their payment structure within the variable rate mortgages for whatever reason, and got left in a very stressful situation. So if there is one takeaway from this episode, understand that variable rate type mortgages, whether it's an adjustable or variable, need to be tended to. They are not an autopilot type of mortgage like you would expect with a fixed term mortgage. Okay, now let's shift gears and talk about the conversion feature that almost all variable type mortgages have embedded within them. Many Canadians are told that with a variable mortgage, they can lock into a fixed rate at any time. And that's true in principle, but the details vary widely with the lender. And here are some common scenarios. So, one scenario is lenders allow you to match the remaining term. So let's say you're 2 years into a 5-year variable rate mortgage term. In most variable rate mortgages are 5-year terms. So if you're 2 years into a 5-year term with a variable, most lenders will allow you to convert into a fixed mortgage for at least the remaining 3 years. Okay, or further out. So at least the remaining term, or anything above and beyond that, 5, 6, 7, all the way up to 10-year fixed term. Other lenders may simply offer you one conversion term, and that could be a 5-year fixed, regardless of how much time is left on your variable. And lastly, some lenders don't offer any conversions at all. Okay, so you need to be aware what your terms are within your variable rate. Before assuming you can switch into any fixed term you like, it's important to ask your lender or broker exactly what your contract allows. Okay, now here's the catch with conversion rates when it comes to the actual interest rate. Even if your mortgage does allow conversion, the rate you're offered may not be the best on the market. Lenders know they have leverage over you. If you find a better fixed rate elsewhere, you'd have to break your mortgage and pay a penalty to move. And of course, lenders know that. As a result, the conversion rate they present for this is often higher than the fully discounted fixed rates you might see elsewhere. So in other words, flexibility exists to convert your variable to a fixed, but it may come at a cost depending on which lender you're with. But that's not to say that all lenders are the same, because that's definitely not the case. Your best strategy is to work with a lender that offers competitive, discounted conversion rates, and ideally one that allows your mortgage broker to actually negotiate directly on your behalf. And this is impactful. This signals to the lender that you're well represented and fully aware of current market rates. When a broker makes that call, lenders know they're being compared against competitors, and that usually motivates them to put their best offer on the table. Okay, so in summary, prime-linked mortgages can be powerful products, especially in a falling rate environment, but they come with nuances that aren't always clearly explained or understood up front. Here are some key points I'll leave you with to ask your lender about when you sign up for a variable type of mortgage. Number one, understand the difference between adjustable and variable rate mortgages. All right. So remember, in an adjustable, your payment changes. In a variable, it doesn't. Okay. And on both of these, that affects your amortization. Number two, ask detailed questions about your conversion options. So, find out what the term lengths are. Are there any restrictions, and timing? Is there a trigger date when you're allowed to convert? So all important things to know about that. And lastly, if you're entering a prime rate linked mortgage, thinking you'll just wait for the perfect chance to lock into a rock bottom fixed rate, you may be setting yourself up for disappointment. Like, the right mindset from day one should be prepare for the worst and hope for the best. And if you're not comfortable with the potential worst case scenario, then you should seriously reconsider, whether a variable or adjustable rate mortgage is the right choice for you. But on a positive note, it is also hard to ignore that the long-term track record for variable rate mortgages, and this spans over several decades, does indeed outperform fixed rate terms. Of course, with the exception of the current 1% and 2% era we are now coming out of with all the refinances. But I'll leave it here for now, and feel free to reach out to me directly if you wanted to discuss what's best for you. Call or text me anytime if you have any mortgage questions at all, especially if you're in British Columbia or Alberta, as I am licensed to service these specific provinces, and especially if you're from Vancouver or Calgary, as I am very familiar with these markets. Come to me for all your mortgage needs. Call or text me at 604-800-9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you are listening to or viewing this. This thing is amazing. It comes equipped with tons of calculators, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try. Thank you again for tuning into Mortgagenomics Canada. Stay well, everyone. Talk again soon.